Hi, we're back with an early global view on Thursday, October 8th, 2015. It is currently 7:45 a.m. U.S. Central Time. We are coming to you a bit later than usual because we wanted to wait and see the U.S. weekly employment claims, which were in fact a bit softer than expected, a bit more upbeat for the economy, but also that is the last data prior to the 1 p.m. U.S. Central Time release of the minutes of the last FOMC meeting. And that's kind of important in terms of the psychological context of the market, especially with a lighter reporting day on Friday, as we will see when we look at the intermediate term charts. So, what does this all look like in the markets? Well, the December S&P 500 future is off 7 today, up at 1980. That's still pretty well up from the from the previous lows going back to the mid to late part of last week. On Wednesday, Thursday, and Friday, you had lows down around 1890 to 88 and even 1883. So with the support having been around this gap higher at 1888 going back to last Wednesday, in fact, this market rallied to over $100 above that support over the course of Friday into Wednesday morning. And 1990, as we'll see, is a very interesting intermediate term sort of resistance as well from back into that actual FOMC meeting. So this is going to be very interesting how the minutes affect the market after it ran up so nicely into that FOMC meeting and then crumbled. Now the higher resistance, there's some psychologically around 2,000. Bigger resistance is up around 2010 to 15 on the Fibonacci level, but also the major weekly chart and channel down break. Lower supports are again down at 1970. Rote supports are down at 1970 and then back in the 1950 area, reinforced now by Monday's gap higher. However, let's look at what happens right when we get out into that FOMC minutes release. This upward channel is going to be right around 1978, and this Fibonacci level the market squeezed above also is right around the same area. So after that comes out, the question is going to be, are we still holding the channel support? If it breaks below it, doesn't necessarily make it bad. That would still take more convincing break below 1968 to 70 than we saw in the dip back on Tuesday, but could well be a sign of beginning weakness if it's below it. If it's not, it's maintaining the uptrend, can probably push up further. Now, the one other thing that's interesting today with the market lower early is that the 30-minute MACD was back below the upper runaway band over the past couple of sessions. And the hourly MACD, that's more important, is still out above it. We'll have to see if there's enough weakness to put this back below that upper runaway band, which might be a very telling sign. And that pretty much does it for the short-term view of the S&P 500, which is leading the other equities around pretty good.